Hello everyone, I'm Akshara Menon and I welcome you to PMS Bazaar's podcast series, a dedicated platform for the in-depth discussions on market trends, industry insights and more. In February 2025, Indian stock market faces significant challenges reflecting the cautious investor sentiment. The Nifty 50 declined by 5.90%, while the BIC Sensex experienced a 5.60 drop, marking its fifth consecutive month of losses, the longest losing streak in nearly 3 decades. The BSE 500 index wasn't far behind, falling by 7.85%. Nifty Small Cap 250 led the downturn with steep decline over 12%, and Nifty Midcap 50 slipped over 9%. We had a lot of factors that contributed to such a market decline, which was like FII withdrawal, global trade tensions, rising commodity prices, currency depreciation, and more. Such markets always worry an investor. So we at PMS Bazaar have come out with an initiative on what an investor can expect from this market. To understand it better, today we have a privilege of hosting Mr. Amit Doshi, a seasoned investment professional with over 2 decades of experience in equity markets, portfolio management, and asset management. Amit is currently the investment director at Midcap Portfolio Management Services, a firm he co-founded in 2011. Under his leadership, Midcap PMS has grown significantly, managing over 1,000 crore for both resident and non-resident clients in Indian listed equity space. Before venturing into the world of portfolio management, Amit spent nearly a decade in tax consulting with PwC and RSM, gaining deep financial expertise before making a shift to building a CAD PMS. As a chartered accountant, Amit brings a strong analytical and strategic approach to investing. With his vast experience and insights into Indian capital markets, we are excited to deep dive into his journey, investment philosophy, and perspectives on wealth creation. Amit, welcome to the podcast.
Thank you, Akshara, so much, and thank you, PMS Bazaar, for hosting this podcast.
Yeah. So the very first question, and every investor would look out for is what is the overall view for Indian market at current juncture?
So I think had this question probably been asked 1 or 2 months back, answer would have been different. But now let's see as recent as possible. So I think the February month had a significant sharp fall. I think post which a lot of stocks, whatever people used to call it a froth, or people used to call it there is a overvaluation, etc. I think that has significantly toned down because the correction has been far. I mean, I was just looking at data, but that data is on February 28th. And I guess more than 65% of the stocks in the BSE 500 had fallen by more than 40%. So a 40% fall was like an average fall. So that broadly takes care of that additional froth that had built in. And I think post that good companies, good stocks are really available at a good price. So somebody who is a long-term investor should not worry. Obviously, in short run, till the time that people are concerned about growth, the Trump tariff war, and such other macroeconomic factors. But as far as valuation of stock, which was one of the key reasons for this fall, I think this price correction has done a decent job as far as that worry is concerned. So as a long-term investor like me, this gives an opportunity, and I see this as an opportunity to invest my funds.
Yeah. So from a fund manager's perspective, you see this as an opportunity to invest. But many investors, who have started investing post-COVID, and this is a very big dip that they have seen in last 5 years. From 2020 is what I meant. So, what is your advice to these investors?
Yeah, I think so. There are a lot of piece of advice which I believe a new investor would need. Obviously temperament, because this is the first time that they are seeing the fall and the kind of fall, and after consistent 4.5 year plus sharp returns. So one, I think patience. The money or the wealth gets built over time. So if you buy today, tomorrow it's not going to grow. So one has to remain more patient. Second, don't invest based on narratives and stories that has been told around. So I don't know if there is a nice this campaign label Padega India. I say that financials Padega India. Anybody who is an investor should probably go deep down a bit before putting their hard-earned money and do that bit of homework before investing. So yeah, I think two key points at this point of time I would like to say to those investors.
Yeah. And a follow-up question, like when you see stocks falling or if they see the portfolio falling down, there's a panic that they always have within them. And there are a lot of stocks that there's a discounted rate, like 20 to 50% from their respective highs. So how should one investor should pick these stocks?
So picking should be based on fundamentals, not on the base of price. Why we also discussed, okay, 40% fall from the peak, 50% fall from the peak. But even at this juncture, whether that stock has value. So that will be first key point. And second is strong fundamentals. So if the company has that growth path charted, and if there is a value, I don't see any issue. So prices are not the right way to look at, that, okay, this stock corrected by 50% or this stock has corrected by 70%. There are multiple stocks which has been 10, 15 times in last 4 years. So a 30% correction or a 50% correction would still have a lot of froth in itself. So don't go by price. Focus on fundamental and the business model and management. So if these 3, 4 things are right, I think that's how you should pick a stock. And if not, then you go to a professional expert advisor where to put the money rather than doing it yourself.
Okay, and let's jump into CARE PMS का portfolio thing. You have given a significant allocation to FMCG, textiles, media and entertainment and for forest materials. Given that India's manufacturing PMI fell by 14-month low in the month of February, do you see is this a temporary slowdown or early sign of a broader economic cooling?
I think it is a temporary slowdown. I mean, so if you see, it's not only the February data, which has been down. If you see Q2 onwards, I mean Q2 of financial year 2025. So September onwards, the results have also been subdued. Our GDP growth had also slowed down, and that is reflected somewhere in the Q2 and as well as Q3 numbers. But I think structurally it was not the case because primarily one of the reason that this slowdown in GDP was slowdown in the government spending. So that was lacking in the first 6 months or say first 8 months. And now with government back to public spending and RBI has also now infused liquidity in the system since last 2.5 months. So I think that the slowdown concern will go away overall and things will start picking up. So I don't see that as a so to say a broader cooling. It is more like a temporary slowdown, and that should pick up once the impact of public expenditure will start flowing in the system.
Okay. See, most of the fund managers are very positive or very much likely about to India's growth story. But when you compare Q1, Q2, and Q3 earnings, so what is your outlook on it? Because Q3 was slightly better when compared to Q2. So how do you expect this Q4 results also, and how do you foresee this?
So Q4 should be better than Q3, surely. And I think from next year onwards, again, I think this year, so what happens typically when you obviously trying to grow your GDP at 7 to 8% per annum, there will be a blips like this. And so this could be a bit of a slow that should not impact because again, this year, next year, again, expectation are still 6.5 and plus. So this should not have any impact. There are, if I'm investing for long term, there will be 2 quarters, 3 quarters where things will not work as per my expectation, and there will be some macro situation, some situation which we would not have anticipated can happen. So I think this is a part and parcel of the long term investment story, and one should navigate through as it is.
Let's talk about the consumption part of it. So consumption spending has been slowing down throughout since last quarter. And what the key measures is the government currently implementing to stimulate this demand? And additionally, how do you see this, forums impacting your portfolio?
Yeah, so I think recent development clearly is the tax relief, which was given to the middle class in the budget that got announced last month. And then amount that has been claimed is around 1 lakh crore. So that's something which will definitely be impactful. Second, again, which point that I just discussed about the public expenditure. Now, just to quote some numbers, government has spent around 2.4 lakh crore in last 2 months, vis-a-vis 5 lakh crore in first 8 months. So the momentum which was missing from the government side in terms of spending was missing, and so that has kicked in. While this is not the first part that I spoke about is budget relief, tax relief in the budget is directly going to impact the consumption, whereas this government spending is not directly impacting the consumption, but definitely that has something to do with the obviously any infrastructure capex would have a significant multiplier impact, and that is going to restart the consumption story. And second, in terms of consumption, so the rural consumption had started doing good after the good monsoon that we had and good reservoir that we have, reservoir levels that we had. So I think only the urban part was missing, and that's something which I believe this with these two macro steps is going to probably change the story. And vis-a-vis our portfolio, I think we also have obviously a few stocks in the FMCG space, which has actually delivered. If I were to look at my Q3 results of those companies, they had delivered double-digit growth. So irrespective of, say for example, if you take the FMCG index, that might have delivered a single digit, but the companies where we have put in money has grown at double digit, and I'm honestly not much worried about that FMCG consumption. But yeah, overall, as I said, these macro things, steps that has been taken will kind of kick in that consumption story back.
Okay. So that was my next question of apparently. And if you see as a FMCG itself, the index itself has fallen down almost by 11% in the month of February. And when you see like your weightage is more towards FMCG. So what is the next or the third sector that CARE PM is looking forward?
Right. So I think FMCG is down, index is down. Obviously, the results were subdued, and as I said, rural consumption was there, but urban was slightly missing. But the fall in the price is primarily driven by this overall market sell-off, and whether it is FI selling or the retail selling. So that's one of the key reason. And FMCG index, has a very limited portfolio company. I mean, limited stocks. Say, I think 12 or 15 stocks is what they would have. And if my memory serves me right, ITC and HUL would combine, very heavy weight, 40-50% of the weight in the portfolio. So if they don't deliver, FMCG index looks delivering a very weak set of numbers. So our companies are not part of that index, the companies that we own in the FMCG part. And coming to your second question about a sector. So at CARE PMS, we are absolutely sector agnostic. So we don't invest based on sector or, we like particular sector and therefore you do top-down approach. We prefer a bottom-up approach, and it is more a company-specific development that we look for. So we have, like you said, media entertainment. So we have companies in that space. We have companies in, so to say, infrastructures, metals. So multiple other sectors. So we don't have a top three sectors that we have betted upon. So I would want to probably leave it there.
Of course, let me take one more sector before we go move to stocks. Pharmaceutical tech sector as a whole it's been quite expensive after Trump's tariffs which is imposed in the Indian market now. So how do you see this pharma sector as a whole?
Yeah, so pharma sector actually is important, and vis-a-vis Trump tariff, that is likely to be impacted the most in that sense. But when you deep down the numbers, for US, Indian pharma is very critical because the consumption that they do of pharmaceutical, 40% is manufactured or imported from the Indian companies, whether it is generics, whether it is specialized, etc. So for them, it is very critical. And what he is currently doing is, tit for tat. So currently, India imposes 10% tariff tariff on the US pharmaceutical. So it is likely that they will also probably do a 10% tariff on Indian pharma companies. So I think 10% should not have a big dent, but still it will be an additional cost for them ultimately, because India is definitely a very low cost producer for them, and it will be difficult to find an overnight shift of the supply chain. And a lot of pharmaceuticals have corrected, after this development of Trump tariff and his continuous announcements. So while we have yet to wait for the 2nd April that he has given a date for, announcing a tariff against India. But yeah, that will be a factor remain to be watched out for. And those companies, pharmaceutical companies, have really corrected a bit, or they have not done well because of this announcement. So I would like to believe any positive development would probably improve the pricing part of it. I mean, valuation part of it. Pharmaceutical otherwise is a very strong sector. Now just we have to split companies, in the domestic space, which are doing good, in the US space, which are doing good. In US also, you have generics and specialization. So overall, pharma sector remains an important. We also have an exposure to pharmaceutical companies in our portfolio, and that industry is growing in double digit, and that's something one must have in the portfolio. But yeah, I think I answered your question to
Yes,
that extent.
absolutely, sir. And moving on to the stock, CAD is meant for, perfect picking part of it. And also, you've been holding a particular stock for a very long period of time. For example, JK Paper, DP Corporate, you've been holding for a very long period, and it has given a multi-bagger returns also. So how do you see that part?
So yeah, I think JK Paper and DB Corp, yeah, so they are one of the holdings. I think for JK Paper, generally, people have myth that, they are digitally disrupted industry. So, it's they are into paper business, which is not going to grow well. But just to clarify for the audience of PMS Bazaar, the packaging, I mean, if I have to do a revenue breakup of JK Paper, more than 50% of the revenue comes from the packaging segment, whether it is the packaging board that we see of pharmaceutical medicines or the toothpaste, etc., or whether you look at e-commerce, the brown dabbas that we see across. So that's the packaging side, and writing, printing paper, copier paper is definitely there, but significant revenue comes from the packaging. Now, having said that, writing and printing paper still grows at, single digit, 5%, 6% type of in India, at least. And vis-a-vis the packaging, that is growing in double digit. So while there is a issue around that, understanding of low growth company, but this company has delivered double digit growth consistently for last 10 years. If you look at the chart, they have done their job well. And any expansion in this packaging segment will further aid to the growth prospects of the company. So that's about JK Paper. And yeah, they are leaders in this segment, so we prefer to stick to that investment. Coming to your second company about DB Corp, again, the similar type of thing, like, a newspaper. So DB Corp is nothing but Dainik Bhaskar, the newspaper company. So Dainik Bhaskar, while it is a newspaper, but again, if you see the revenue breakup, 80% is the ad revenue and 20% is the circulation revenue. But the way we look at it, the DB Corp, is that is nothing but a news media company, where the core part is the content, the news that they gather. So they have more than 10,000 employees, people on the field who collect news on a daily basis, and that is the content. Now, how we consume the content, that is different. So, for example, newspaper, which used to be, they are still not at pre-COVID level in terms of the number of copies that earlier used to be sold pre-COVID. But the way we have changed is, of course, now we see the news on the mobile or in the video format, etc. But what DB Corp has done in last 4 years or so, they have spent more than 300 crore in developing their app. And their news application is highest. It has highest monthly active user. So they have around 19 to 20 monthly active user as on last con call that they had shared management, and it remains to be highest in terms of any news app that you have to compare it in India. So which clearly indicates that they know that the consumption has shifted from newspaper to the mobile applications. So they have diverged, or they focus their attention towards that. So far, the management does not share any, so to say, separate segregation of digital business versus paper business. But once they will start monetizing the same, and it will start replicating, I mean, it will throw up in the numbers. And we believe that is a very good story for futuristic. So while this is a digital, so from paper to digital, they themselves have focused from paper to digital, and therefore we continue to believe it's a very strong story. They have a good cash, 950, almost 950 crore on their books, and they have a good dividend payout master. So overall, a very good story that we believe has a very good future over a period of 2 to 3 years, because that's where the digital story will start monetizing themselves.
Yeah. And before we move on to the next question, I would like to give the listeners a disclaimer stating that any stock which is being spoken in this podcast is just for educational purpose, and no recommendation from PMS Bazaar, nor from the CARE PMS side. I'm just putting a disclaimer before. Moving to the next. CARE PMS is more for small and mid-cap opportunities. And last month we could see that that has been onto a red for a very long time. And so, how should an investor approach, a small and mid-cap sector at current junctures?
We particularly don't, so to say, like classifying any company based on the market capitalization. So, but yeah, as per SEBI norms and as per the index classification of small, mid cap, etc. So anything which is say around 27,000 crore, less than 27,000 crore is classified as small cap companies. So the first thing is what I would say is that to classify, or because generally, like you also asked the question that the small cap, mid cap people are concerned about the fall in the small and mid cap space. So what typically happens is people get colored by anything which is in small cap, mid cap is worrisome. So that's not true. I mean, company with a market size of 25,000 crore, is not something that has come out of thin air. That has have had its own history for last 10, 15, 20, 30 years, and they have built a strong business around them. So having said that, the fall correction that has happened, and that's across board. So I think this situation is very good. It's like that ringa roses, and that all fell down. So the good part is everything is fallen down in small and mid cap space. So we see this as an opportunity. I mean, we have to accept that whenever correction happens, whether it is good company or a bad company, everything gets corrected, and we don't intend to classify, as I said, small or large cap. Yes, typically in times like these where people become conscious or cautious against investing in stock market, equity market, this company's valuation tend to kind of slow down or low down. But overall, they have delivered better returns. In fact, I was going through data last week that if any person had invested after a fall from bull market, typically first large cap moves, then mid cap moves, and then small cap moves. That's how generally historically it has happened. But even if you had put money in small cap after the correction, overall, if you compare all the three baskets, the return in the small cap index has been the highest, provided you look at good quality stocks and you invest the money for long term.
Probably a follow-up question for that. Let me take a cash call question now, because majority of the investors in PMS have taken a big cash calls in the month of Feb. So how is your portfolio being positioned?
So now, as we speak, I think we have very almost low to nil kind of a cash situation. So we definitely had cash initially, say 6, 8 months back. Then we kept on deploying. So what we did in last is 6 to 8 months, everybody somehow had that concern or worry that there is this market is definitely some sort of valuation concern, because the way IPOs were getting subscribed, the way SME listings used to happen, any small news or announcement used to make stock prices jump by 5, 10, 20%, on circuit, etc. So that it itself gives a lot of signals. So we had some cash at that point in time, but we shifted our so we have two strategies. One is growth plus value, and one is large and mid cap. So in growth plus value, whatever cash that we had generated, we shifted that to the large cap space. So what happened is, so now while this is a small cap focused company, small cap
Correct.
focused strategy, 25% of the portfolio got invested in the large cap kind of companies. And fortunately, the market has been I mean, I would say like everything is corrected, but yes, the correction in the large cap is slightly kinder and smaller vis-a-vis the small cap. And therefore, to that extent, it is protected. I mean, the pain is slightly less, is what I would say. But yeah, at the moment, we have not, and I don't think at this juncture, anybody having cash should start utilizing cash. Somebody may not want to jump totally, but definitely a phase-wise investments in this type of market, because as I said, prices have corrected significantly and the froth in the good companies have definitely been out.
Well, that's one kind of a risk mitigation that you have taken. Instead of holding it in cash, rather, putting it into large cap would be a better opportunity. And also, thank you for
Because
that.
nobody can time it, honestly, Akshara. Nobody knew, the kind of correction will come, whether it was on the election day, June 4th, whether on the budget day when the capital gains tax were increased, everybody was anticipating a fall, but nothing
Yeah.
happened. So nobody can time it. So we thought this could be a better strategy to handle this
Yeah,
kind of
as
markets.
someone said, time in the market is more important than timing the market. So that's the way. And okay, because I'll say that, the markets or the narratives around the market has been very negative. Like, can say FI selling, or it can be the Trump's tariffs, a lot of, negative things that is moving around the market and just making the market fall even more further. When people or investors are refusing to see the fundamentals on the other side. So if there's any three positive things about the market that you want to tell it to the investors, what would that be?
Uh, The first thing would be India remains a very structural, strong story. The domestic demand itself, the domestic demography of our country itself gives a lot of demand for growth. So that is one of the first and foremost and probably the most key factor to this point. And other two, I think I'll be repeating myself, but yes, the government's focus on the growth, because you look at the budget and the kind of tax relief they wanted to boost the consumption story shows in that. And the third is RBI. So if you listen to even the new governor's speech, who has recently joined, they've clearly said that our priority will be growth, and which can also be seen from their action of infusing continuous liquidity in the market. If you look at last Q2, Q3 con calls of banks, one of the complaints was that liquidity is missing in the market. So this shows that government as well as RBI wants to focus on the growth and the demography that India already has the potential. So all three put together, I would say this should be the positive ones. And as they say, in bull market, all the negatives are disregarded, and in the bear market, all the positives are disregarded. So I think these key positives somebody should keep in mind while thinking for next 3 or 5 years.
Okay. So when you say that, and you have one strategy which is growth plus value. So it's a blend of both growth and value. And generally, value tend to outperform in a high interest rate environment, and growth tend to do well when liquidity is available in the market. So how do you manage? Like it is like, what kind of a percentage do you want to give it to growth and value at this current market juncture?
Yeah, very nice question. I think so the way we look at it is so the way whenever we pick a company or select a company, so there has to be a trigger for growth and there has to be a value. Now, value can be in two ways. One is, where is the structural value discounted, or, people call it value traps, of the company. But so to answer your question in particular, like it will always be a combination of growth and value. And yes, your observation is right that, growth stories generally picked in the time of liquidity. But here I would want to add one more thing is that what typically happens when liquidity flows in, the narrative based, the stories which are float around in the market. So, for example, what happened, say, 1.5 year back to defense, then railways, then EVs, then recycling. So, those themes get more and more traction. So, whenever liquidity is there, that is right. But ultimately, over a longer period, growth and value, which combination will work better. So, in current times also, I think so we have mixed of both. We never got into the percentage of what percentage carries what, but yeah, we will try and mix depending on what opportunities arises, because currently the way market behaves is very wide volatility. So yes, so growth and value both has to be in combination. It can't be either of the side.
Okay, correct. And before we giving a closing, I just want to give one question. Like, what are the three exits that CAR has done in last few months? Like stock exits.
Complete exit of the from the
Or
portfolio.
partial exit or a complete exit, and why?
In terms of, I'm not sure if I'm allowed to say the names of the stock that we exited or profit booking, but one of the key reasons were two reasons, I would say. A, it did not perform as per our expectation. For example, let me give you an example of FDC, which is one of the pharma companies that we had invested our money in. It did not perform the way we had anticipated. And when we look at its performance, we compare it with the other domestic players or other pharmaceutical players vis-a-vis the performance of our portfolio company. So that did not deliver well, and therefore we thought of making an exit from the company. Second, sometimes what we do is we do profit booking, because it's part of our routine portfolio balancing activity, whereby whenever there is a whatever, say for example, if we have taken a weight of say 7 or 8% in the portfolio, and it has, because of the sharp rise in price, it has jumped up to say 10 or 12%, then we trim down the weight. And the third reason that we so to say, we exit a company is if we find a better opportunity. So if I have something, so for example, say Zydus Life Science is something that I prefer over FDC, then I would prefer to exit FDC. I'll say I'll better shift my money to the this company, which is doing slightly better opportunity. So these are the three reasons why we would want to exit any particular company. And yeah, FDC is one name which I shared. A couple of more names could be Adore Welding, which is not doing as per our expectation. And say, for example, we shifted some of our FMCG, I mean, the consumption story shifted to say Adani Wilmar, which is doing better vis-a-vis the rest. So that could be the names that I could share.
Yeah. As we come to the end of the podcast, but still, the whole podcast initiative was to educate the investor on the current market. So, how was your investor, reacting to this current market? You would have got investor complaints, or you would have got investor calling you, asking you about the market. And how do you handle? How CAR PMS handles?
Yeah, I think we have also grown over time. So the fall that we saw in 2018 to 20 was far tougher for us in terms of handling the client who had been the newbie investor post demonetization, if you remember, in 2016. But this time around, we have been very cautious. We have been telling each and every client that you are here not for 1 year, you are here for 3 or 5 years. So there is a possibility of correction. But one of the key thing that we handle or navigate is addressing the client's concern. The one of the client concern is that are we in the right companies? So educating the client about the companies, the nature of business, and what are the rationale pursuant to which we have invested our money in that. So if we educate them, I think they are sorted. They understand that markets have been obviously are turbulent, and advice, I mean, educating them towards this point is somewhere put a lot of concerns to meaningful way in terms of they getting calmer more. I mean, this is primarily for the newbie investor. The clients who have been with us for last 14-15 years have been absolutely no calls, no emails, nothing doing. It's a part of their routine, so they understand various cycles.
So investors are getting matured with the market.
Absolutely. Absolutely. Yes. I think a lot of, mutual fund campaigns has also done our job a bit more simpler in terms of, explaining these market cycles.
Perfect, sir. I think with that, we have come to the end of the session. And thank you for taking time out to educate the investors, our listeners, for the podcast to understand about the market, about the CARE PMS products, and also more about each sector and each stock individually. So it has been a very insightful one today.
Yeah.
Thank
Can I just add one more point, Akshara? Just click me.
you.
So you asked about the newbie investor. What typically happens in this bull market or last 1.5 year that we have seen. Lot of client builds their portfolio on the basis of their narratives that has been thrown around. So this is the best time to reshuffle your portfolio. So if anybody has whatever portfolio they have built over a period of time, especially in last 1.5, 2 years or so, this is the best time somebody can reshuffle and shift to a better quality companies in the portfolio, irrespective of the price correction that they have seen in any particular company that they have invested their money. So this will be one of the very key advice that any investor should reshuffle their portfolio, because this is the best time to, so to say, reshuffle and for the preparing yourself for the next up cycle.
Good. I think that is one of the biggest takeaway from this podcast, where you're saying it's better to stay invested or to reshuffle your portfolio rather than staying at cash or away from the market. This is an opportunity is what I could take away from this podcast.
Sure, definitely.
Yeah. Thank you, sir. Thank you for that, and thank you for your time.
Thank you, Akshara, and thank you, PMS Bazaar, for this podcast.